Hey, folks, welcome to Thursday's Market SITREP here at Top Gun Options. I'm Wiz, Matthew Buckley, the Chief Option Strategist at TGO, and obviously the lead instructor. Wrapping up being down here in Miami, we should be having our regularly scheduled Analyze Your Trade and Debrief. I'm actually going to open it up to all my members at 1 o'clock since I was out of pocket a day or two this week. I sent out an alert yesterday, actually the accelerated retirement, a new CSX, Charlie Sierra X-ray bull put spread, and that along with the video, so that should be on the page. Okay, a lot of interesting stuff going on right now. Obviously, I'm shooting this pre-market opening bells here in about 4 minutes. Futures are pointing to a pretty significant lower opening here on a lot of the issues we've talked about, and the chickens are starting to come home to roost here. Like I've said for the past week, since we kind of hovered around this 50-day moving average on the S&P 500 and then ripped higher, I said, hey, markets don't do this, and they eventually get back to doing what they should be doing, and they're about to do that today. So it looks like this 200-day moving average, as I said yesterday, is going to be a resistance, and we're probably going to give some of this back. And as I've repeatedly said, and I'm just going to say this until it's second nature to you, like it is to me, markets don't live between moving averages. I like to say it's like World War I trench warfare. You know, nobody runs around between the two trenches, man. It's either a rip to one or you stay around the other one. But let's get to it and talk about some of the issues. The U.S. trade deficit with China narrows as effects of trade war induced export front loading begin to fade. So our trade deficit with China fell $2.8 billion to about a $35.4 billion, and NOV led by a decline in U.S. imports of consumer goods. What's that going to be? I haven't checked Twitter today. Twitter's in the news. We're going to dance all over that grave. The data will be well received by Trump, who has railed against the U.S. Perceived lopsided trading relationship with China. Obviously, this is a headline the president's going to like, the Chinese aren't going to like, but as seems like it's a dead horse here, guys. But this is one of the major overhangs of the market. Well, actually, Europe peeked its head up above the trench today, and we're going to talk about that potential overhang in a little bit. But both sides are getting bloodied. Both sides should win a deal, and hopefully in March we're going to get some sort of positive announcement. We put on a burner trade. We came up with a new name on Tuesday in our live trade brief called a burner trade, bullish on FXI. That's the iShares China ETF, and it had a nice little pop earlier in the week and actually gave all of that back, but still a really good trade. If you didn't get in that one on Tuesday, I'd take a look at it because it's a pretty good looking trade that something gets done in March. Okay, we have that self-imposed 90-day deadline coming up in a couple weeks here that they did in Buenos Aires, and something, either nothing happens, something happens. Or something really good happens. So if the nothing happens, that's bad because the president said, "Hey, man, if nothing happens, we're gonna keep firing." Well, we are still firing. I mean, actually fire harder. So that ain't good. But I think the pressure's on for both sides to make a deal. I understand China could really care less about its people and whether or not they're undergoing economic hardships, but that's got to get to a breaking point as well. They don't want another type of Tiananmen Square if people get too upset. So I think we're going to get a deal, and that's why I'm bullish on FXI out to next month. So let's dig into this. U.S. stock futures point to an opening fall on weak data in Europe. Man, there's an absolute clown car. So the EC, the Brexit, investors have had to grapple with conflicting economic signals. Sounds familiar. Sounds like the United States. We've had conflict. Housing's imploding. All sorts of stuff is imploding, but employment's up and wages. Something that has kept enthusiasm for risk-taking contained. So we're really seeing a slowdown over in Europe, and it's kind of a global story too. We know the one place that we kind of like that isn't seeing a slowdown. We're seeing kind of a Trump rally is down there in Brazil. Now, the other day, what was it, a couple weeks ago, that dam that broke down in Brazil. One of the big reasons this gap down in the EWZ, in case you didn't know, is Vale, V-A-L-E, huge Brazilian company. I think was owned 65% by the government. owned the dam that broke and killed, 150 people, were warned like weeks before. Some inspectors came in and said, this thing's going to break and it's going to kill a lot of people. They're like, yeah, whatever. Shocker. And then it broke and a lot of people got killed. So that was breaking news the other day, that the company was warned about this dam and they didn't do anything. That's not good. So they're a big part of the Bovespa, the Brazilian stock exchange. So that's why that took a hit. But if we're looking at a global growth slowdown, it's Europe, the economy is suffering under the strain of Brexit and talks of extending the uncertainty. Just get it done. I think even the Queen jumped in the other day and said, hey, just kind of get it done. So now that the Queen is involved, maybe it'll get done. Here's what we need to talk about for the major thrust of our SITREP today. I love this headline. This is probably one of the best articles I've seen in a long time in the Wall Street Journal. If you are a member, get in the ready room, because scroll down. I put the first post is great read for today. So click in here in the ready room and read this Wall Street Journal article. Just click on the link right there and read this article. That's a direct order. This isn't a request. You are to read this article, and then you know what you do when you get done? Reread it. Companies are on track to report a 1.4% decline in profits for the first quarter from a year earlier. And again, you have to read this, but I'm going to dig into this. So the year-long expansion in U.S. corporate profits may be coming to an end sooner than investors expected, a warning sign for the nearly decade-long bull market. What have I called this thing? I incorrectly called it a bear trap the other day. I had to do 50 push-ups. This is a bull trap here, folks. Let's dig into this. More than 30 companies in the S&P 500 have offered first quarter earnings forecasts that fell short of analyst estimates. Okay, so and it's funny, down here the article talks about, hey, 70% of companies that have reported earnings for Q4 were beats. Well, guess what, folks? When you can't hit the ball over the net, what do they do on Wall Street? They lower the net. So guidance. Remember Apple? Apple about a month ago, Tim Cook in an interview, we're going out of business. A week later on Jim Cramer interviewed him in his headquarters with softball questions. He's like, no, everything's great. So that's exactly what happened, is if you can't hit the ball over the net, lower the net. So the Q1, actually we're sitting in Q1. So Q1 earnings forecasts are not good, man. So the forward guidance, remember we had great earnings back here for Q3, and what happened? The stock market imploded. We've had kind of tepid earnings for Q4, and what's happened? Rip your face off rally. That doesn't work. But here's the headline I wanted to say to you. Corporate earnings don't always move in conjunction with stock prices. So, oops, sorry about that. So this is the wisdom. So about a couple minutes ago, I said, hey, markets don't do this. And if they do, I kind of sit on my hands and watch. This is the sentence. Corporate earnings don't always move in conjunction with stock prices. And as I said, earnings have often surpassed analyst initial estimates in the past year. Roughly 70% of S&P 500 companies have posted better than expected earnings for Q4, despite, a lot of vol and uncertainty. So that's it. They obviously, the journal said it better than I can, but this rally ain't matching the numbers. Okay, so that's what I'm trying to get at here. So so let's keep digging into this for one more second, because there's some good stuff on here. So given the fact that we're seeing a slowdown in the 10th year of an economic recovery, there's persistent fear that every slowdown we witness will be the big one, right? They grab your chest, and this is the big one. Here's what I'm going to leave it at, is this: if Q1 comes to fruition, how bad it's going to be. This would be the first time in about a decade we've seen negative earnings growth, and that ain't good. So like I said, give this a read. I'm not going to spend too much more time on it. Probably the best article I've read in the journal in a while, and it's going to give you a heads up as to why I kind of looked at like the the RCA dog on a record. I'm dating myself. Everybody remember the RCA dog? He'd stare at the big, the speaker thing with his head kind of cocked sideways. That's been me with this rally, with my head cocked kind of sideways. And now the chickens are starting to come home to roost. Now the Dow futures are down 170. Yeah, we're going to be down at the open here. The only reason we're not down about 500 points is what? SunTrust and BB&T are merging, trying to form the sixth largest bank. Now, obviously, they might run into some government issues and some antitrust issues, but that's kind of good news. But let's start dancing all over the Twitter grave again. In the Reddit room the other day, I posted, hey, if you're looking for a captain, it's shocking to me that I'm actually saying this, but if you're looking for a Captain Kirk trade, maybe it's the FANGs. And I'd like to say the T silent in the FANGs. T would be Twitter. But look at this. Twitter shares are down, let's see, about 8% right now. After what? Monthly active users fall for the second quarter. You want to know why? Well, that's the second quarter. But guess what? when Twitter bans, I got my Matthew Buckley Twitter account, about 4,000 followers. What happened? I got booted off of Twitter because I said something that somebody, with purple hair and a nose ring didn't like in some office somewhere about former President Obama. So couldn't happen to a worse group of people. I hope this company goes out of business. I don't like people losing their jobs or anything like that, but I do when those people don't like free speech and are these type of people. So can't stand Twitter. Hope it goes to zero. And if the only reason Twitter is still in business is Donald Trump. That's the only reason Twitter is in business. Let's see currently what it's doing. And if that guy left tomorrow, they'd be like, almost 10% drop today. What did I say, man? I said get bearish on the on Twitter about a year ago, and look at where we are. We're essentially flat now. If that, geez, that's awful. All right. I already beat this to death. The other reason this market's had this rip your face off rally is the Fed. I used to think Jerome Powell was great. I've said he's the right Fed chief at the wrong time. Well, now he's the wrong Fed chief at the right time. He should have stuck to his guns a little bit, but he didn't. He blinked. Back here he was doing his job as the sheriff, and the people rioted, and he said, okay, I'm not going to do my job. You guys be nice. And the market kind of played along here. So I just think we can't have, you ready for this? We can't have any more dovish talk from the Fed. They've kind of been as dovish as they can. I mean, I guess the dude could come out and say, hey, we're going to cut interest rates or maybe even quantitative easing. Let's do what Ben Bernanke did. But the market's already up here. So as I said the other day, the market's kind of up here on hopium. And years ago, I used to call this type of stuff the MacGyver rally, right? We're kind of up here. Remember that show MacGyver? This market's being held up by a straw, a paperclip, and a rubber band, and it ain't that ain't going to last. So I'm glad we have some hedges on. Somebody posted in the room yesterday, hey, what do I do with these SDS hedges? Guess what? It's Thursday. The Dow's down about 200 points. This is why you hedge. And I like to, when I talk about my hedges, I say, just like, what was it, the Ronco oven or something like that? Remember that? Ron Popeil? Set it and forget it. When you put hedges on, you put them on for this reason. I mean, hell, something could happen tomorrow too. This is why you put hedges on, and something could be. Anything can happen, even before the market closes. We're going to talk about at 1 o'clock today. Should be back up north by 1 o'clock about two of the big winners in the president's speech the other day: defense stocks and infrastructure. So that's why we looked at a bullish put spread on CSX yesterday. And if you didn't get in that one yesterday, I think it's still relatively around the same price, so it still might be a good trade. And also, we're going to take a look at Raytheon. Going to get back into Raytheon here, and with the Dow down 300 points, both Raytheon and CSX are probably the only green on the screens here, which is good. That's good to know. So, all right, guys, I'll tell you what, I'm going to start head north from Miami down here, and I'll see many of my members at 1 o'clock. As I said, no coaching tomorrow. I'm heading up to Boston to see my boy play some hockey at Harvard, and then up in Vermont. So, I'm looking forward to the cold. I'm in Miami now, and going to be up in I think he said it's 10 degrees up in Vermont or something like that. So looking forward to a good weekend. But have a great rest of your day. I'll see many of you at 1 o'clock, and God bless.